Factor investing is, we don't bottom-up invest anymore, or certainly large parts of the market don't bottom-up invest anymore. They don't pick individual stocks. They slice and dice the market based on a bunch of different factors. So we talk about factor investing, liquidity, whatever it is. You guys have been big beneficiaries of that. How much further does this have to run?
Well, we have seen a significant shift from active into passive over the past few years. And for sure, only last year, we saw 600 billion euros moving from active investing into passive investments. We are forecasting that ETN, which is exchange-traded notes, products, and ETFs, will have in total around $15 trillion by 2025. And there are some of our clients, some of our asset managers we work with to design some of those strategies that you just described. They're forecasting that the market is going to be as big as $25 trillion by 2025.
Where is the biggest growth? Is it smart beta? Where are you seeing the biggest kind of hit at the moment?
Well, if you really try to segment the market, every single layer of benchmarking is growing at significant rates, because of inefficiencies of active managers and because of the transparency in the rule-based and the way you can really construct portfolio using indices is much more efficient. The fastest growing segment is clearly the access layer, which what we have been historically as being the traditional geographical and duration benchmark in fixed income, as being the big beneficiary. That's why the SPY, the S&P 500, saw significant inflows in the first 3 weeks during the month of May, which were basically as big as all the inflows that they saw for the rest of 2018. But at the same time, factor investing and thematic, which are the two layers above that, are seeing the fastest growing rates at the moment in terms of adoption from large institutional investors and also from the retail.
Is there a point at which those two layers sort of can't grow anymore? Presumably, if everybody's doing it, smart beta doesn't work if everybody's doing it. So if there's too much money goes in there, is it kind of self-limiting?
Well, I think there is a combination of things. One is the research that we, as index providers, put into the definition of some of those factors. And really and second, what kind of risk premia you can really define using those instruments, those indices. What we have done as STOXX and Deutsche Börse, for example, we listed futures on all our European factors, so that now investors and traders can gain that exposure to that risk premia also in a market-neutral setting by shorting the existing market, or which is already available.
Do you think, when regulators look at what is happening, do they worry when you have conversations with regulators? Is there a conversation, part of the conversation, that focuses on risks and kind of a lack of visibility on some of those risks that may exist within the ETF universe?
Well, you have two components of that from a regulatory point of view. One is, of course, all the instruments that we produce are objective, rule-based, transparent, and very cheap to implement. So from that point of view, regulators are clearly welcoming what index provider can potentially bring to the table and how we are eventually changing the asset management industry. On the other side, there is the entrance of benchmark regulation, which will kick off in January 2020, which will effectively force all the index providers to have a very robust processes around their index management and index operations.
Where are the biggest trends that you're going to see emerging kind of going forward? You've talked about the growth in the layers that you just discussed and what is happening with those layers in smart beta. What about other areas, sustainability benchmarks, corporate governance, all of those other benchmarks, which kind of you almost need to make the package complete in terms of understanding, because otherwise you end up in an environment where kind of everything's passive, but there's no sort of feedback into how some of these companies and systems operate.
Going back to those, that factor investing and then thematic. Thematic is where we really see the fastest growing at the moment, fastest growth at the moment. And that's driven by institutional investors looking at global macro trends, aging of the population, disrupting new technologies, things that are around us and will always be around, and somehow they're changing the way we live, and therefore they want to have exposures for the next 5 to 10 years as part of their portfolio constructions. We have been leader in that space. We launched since January this year one of the first AI-based index because
this is my next question.
Because
AI,
we are clearly looking at the way we're going to manage growing amount of data, and artificial intelligence is the way of doing it. And somehow, going back to your question regarding sustainability and ESG in general sit at the intersection between factor and thematic, because through ESG, so if you have a very high environment, social, and governance score, for example, research shows that the volatility of your earnings or your cash flow is much lower. So you are a much more conservative company, and therefore, you are a less risky company.
Okay, you kind of dealt with some of the AI stuff. Let me ask you a different question then. Volatility has been suppressed for a long period of time, stock volatility. If you were to see, how big an impact would it have on demand for your products if you were to see volatility, I don't know, the VIX go up to 30 and stay there? Is there a kind of feedback loop that affects the sort of desirability of some of the products?
I think somehow we're facing very interesting market condition at the moment, right? Volatility is back to quasi-normal level. The curve in the US will flatten out, with rates going up, even a lower pace compared to what investors are expecting. And there is clearly geopolitical risk. Well, we're seeing what's going on in Italy, right? So clearly, I think going forward, the low volatility strategy will potentially become popular again. We've seen a significant demand a couple of years ago. Last year was a year where low vol strategy tend to underperform in some cases, and now they're clearly coming back in terms of popularity. I think as index provider, our responsibility is to really offer to the investors a tool, a set of all the possible available indices that I can use as underlying for products, and that can potentially be securitized in the form of an ETF for the mass retail market.
It's been great to see you this morning. Thank you very much indeed for coming to see us here at Bloomberg. Matteo Andreetto, the CEO of Deutsche Börse's STOXX unit.